And that's probably not a bad setup. You consider the weakness that we have, and we're going to go right into bank earnings at the end of next week, and they're going to be very depressed if you think about it. You know, Bank of America, Citigroup making new multi-year lows here today. They're below the levels they were at their lows during March during the regional banking crisis. So obviously not the beneficiary of those big regionals that went under and some of the stuff that we've heard from, let's say, JP Morgan benefiting from the deposits they've gotten. But if the stock market is a discounting mechanism, right, and we've had this recession that, again, was a near certainty when the stock market was at its lows last October, has been pushed out here. If I'm just looking at my screens right now, okay, I see the XRT, which is retail, is down in the year. I see banks that are down in the year. I see industrials that are basically flat. I see materials that are down in the year. I see, I mean, the list goes on and on. I mean, healthcare is down in the year.
So equal weighted S&P is down on the year.
Equal weight's down in the year. The Russell 2000 small caps are down in the year. So all I'm kind of trying to say here, and I've been saying this for a little bit now, it's not that healthy of a stock market, in my opinion. Now, it was okay when we still had that concentration, right, when we were at the highs, and now we're almost down 10% in the S&P market cap weighted, because there was all this talk about broadening out. It really wasn't broadening out. Under the hood, we did see some weakening. So I guess my point is like the lower we go here, as we get towards some technical levels, I know the S&P is very near that 200-day moving average, that uptrend that's been in place since last October. I mean, these are the things that you want to keep an eye on, because if some of the bigger names in the market that are really like have to do with most of the gains in the broad indices, if they join the party, and just so you know, I mean, the Microsoft and the Apple, we've been talking about this, they already have broken down. I mean, technically they are broken, but they're still up a lot because they were up so much to start off the year.
Apple traded well again.
Yeah, no, it did. I mean, listen,
you're right. You're right, by the way. But I mean,
I think, but where else are you going to go right now? I mean, other than you know, T-bills. You know what I mean? Like you're going to Apple, you're going to Microsoft right now. So they're finding a little bit of support right now as money's moving out of these other sectors.
Yeah, I mean, the hurdle is going to be very high for that investor to decide, Mike, to put that incremental dollar into stocks versus bonds at this point. And the hurdle gets higher and higher each day, with rates going higher and higher at this point.
Yeah, well, there are some stocks that might behave a little bit more like bonds do or will. You know, we own Constellation, which is going to be reporting soon. We own Johnson & Johnson. You know, these are the kinds of stocks. They're low beta, which I think is going to be helpful in a market like this. Look, if rising rates are bad for companies that don't generate cash flow now, that basically have high duration and high beta, then you sort of have to look for the opposite if you're going to be long stocks. Like Karen, we have to be long stocks, so those are the ones we're going to own. And we have picked up a few financials actually going into earnings simply because, you know, maybe there's a lot of bad news priced in. We swapped Goldman for Morgan simply because I think this additional volatility is probably going to benefit on the trading side more than the asset management side as asset prices decline. That can't be good for Morgan Stanley. But I think that's kind of the choices you're going to make. You're looking for the best house on a bad block. Right now, the stock market's a bad block.
Well, the bond market's a bad block, too. So what's really interesting, everybody's talking about, hey, isn't it a great time to own bonds? It's not been a great time to own a lot of bonds. So anyone that extended duration in the last 3 weeks and was told by someone that this is the time, you've got reinvestment risk, you got to get out there. I think it's fascinating. By the way, my Haribo Bear Index here, which is now at 4 gummies on the desk here, is look, we're at a place here where I think sentiment really is awful. And you have a place here, too. Dan's talking about the positioning of the S&P. If you remove the SVB chaos of March, this is, if we go through the, you know, we're actually 10 bips away from the 200-day. If you traded through the downside on the 200-day tomorrow or sometime next week, it would be the first time through to the downside if you remove SVB, going all the way back to January, February of 22. And this is back when the Fed was obviously stepping up. We were getting 75 basis point cuts on the horizon. I'm just telling you that this is a place where if the stock market is breaking down through the 200, we haven't seen that in a year and a half. You can talk about SVB. I would make an argument that was isolated. Doesn't mean that there weren't tensions that are similar to the ones we're seeing today. But the market itself, the S&P, is measured by the 200-day holding, not trading through. This is a year and a half. We haven't seen this. And again, that gets back to the beginning of this cycle where we didn't know how aggressive the Fed was going to be. And it's kind of what people feel like right now.
Yeah, but in terms of the bond volatility that we've seen, because it has been extraordinary. I mean, TLT saw a record day on volume in terms of shares traded, which is extraordinary to think about. And take a look at our chart of the day, because think about the positioning here in the bond market in terms of the wall of issuance that we are expecting. Right. Who is going to be that buyer? It's definitely not the Fed. And it's not China. And this is a chart that had been making the rounds today. It's from Apollo's Torsten Slok. And he basically said $300 billion in bonds have been sold since 2021. $4 billion just since April of this year by China, and they don't have additional dollars to recycle back into the bond market. And maybe politically, if they did, maybe they wouldn't want to.
Well, a couple things to that. I have been short the TLT. I did cover another third. I only have a third left, which feels painful to do. But to that, who's going to buy them? Whoever's shorting maybe into this. We know when they say when they're going to issue debt.